Hey everybody, welcome back to my channel. In this video I'm going to give you my take on whether I think that we are in for a housing bubble burst in either 2021 or 2022. Now I've made a similar video to this in the past, and this was on the forefront of the coming inflation surge that we were seeing. Now with my latest video that I have been telling you that inflation could calm at least on the consumer price level and the producer price level temporarily, this question needs to be revisited on whether we could see a bust in housing. So if you've been following what's been going on with the housing prices, and if you've subscribed to my channel and been watching my vids, you're probably interested in this content, and I'll suspect that you have. Housing prices have climbed by a whopping 20% in the last year. Yes, that's right. They've been jumping by 20% in 1 year, which is just unprecedented. And this would put us at levels of growth that we have not seen since the housing bubble in 2005. So the chart that I'm showing you is a measure of the home prices as captured by the S&P Case-Shiller U.S. National Home Price Index. Now, the federal government has got their own housing price index, and this also captures a growth in housing prices, but it's not nearly as pronounced as the Case-Shiller Home Price Index. So I'm going to be using this to try to show you, to point out the growth that we are seeing in those housing prices. Now, obviously, there's many different takes by many different YouTubers and analysts about what's going on. Some have been concerned that the recent eviction moratorium may thrust us into another housing crisis. According to the AP and the economic sources that are back in the AP, and then I'm just quoting this article here, we could be heading to the worst housing crisis since the Great Recession. Now, what's their reasoning for this? Well, the eviction moratorium has just expired. And despite the Biden administration's attempt to reinstate it, the Supreme Court has overturned it. And essentially speaking, because the courts have overturned it, I'm not sure if it went to the Supreme Court or not, or if a federal court overturned it or not, but because the courts overturned it, it means that essentially whatever was a ban on eviction, saying that landowners could no longer evict their tenants, could come to pass, and this could prompt a wave of mass evictions from rental properties and houses and stuff. And because of that, it would prompt an increase in supply of rental and home units available to rent. And because of that, it could drop prices because now there's an increase in supply of availability of units. Now, one of the interesting things to note here is that the rental vacancy rate has been, relatively steady during 2020, which is interesting to speak of because there has been talk about how there has been a shortage of housing and rental units to fit people in, which has caused these housing prices to jump. And so when we take a look at the inventory of housing as far as active listings, that is houses available to be sold, they're at all-time lows. They're just coming back on a curve up since bottoming out in April of 2021. But when we take a look at the historical norm, when we're used to seeing at least 1.2 to 1.4, or even as high as 1.5 million housing units available, we've seen that there's been kind of like a downward trend as time has gone on. But with the onset of the pandemic in the spring of 2020, we've just seen the availability of units plummet, and that's probably due to the mass shutdowns, which has curbed housing production and inventory, combined with low interest rates and monetary stimulus fueling demand for people to purchase homes or at least refinance. And the other thing is that people are not leaving their homes. They are staying in their homes longer, and there's kind of a rigidity to movement of people right now. The other thing that's interesting is that there has also been, and this can be contrary to what I've just said, but I'll let it fit in just a second. There's also a migration from states that have enacted very, very tougher lockdowns to states that have more lax conditions, okay? And that's really coming from areas like New York and California, where people are moving and listing their units and homes for sale and probably selling those, but when they come down here, they're not finding such availability because of this shortage, and that's just what's, continuing to increase these prices. So the reckoning is that what goes up must come down. This is obviously a housing bubble. It is unsustainable. It is unsustainable. And so eventually it's going to get to a point where rising costs are going to eat into housing production, or, investors get in and start producing too many houses, and it starts creating a housing bust, a drop in the housing prices, which would then cause a massive round of bankruptcies. Businesses would go bankrupt, people would lose their jobs, they'd be unable to pay on their homes, and we would have another crash like 2008. Now, the reasoning is sound on a surface level, but we need to start digging into a little bit more depth right now to see if there's any kind of substantiability to these claims and worries, okay? So the biggest one right now is to take a look at the delinquency rates on mortgages, okay? One of the things that fueled the collapse of the mortgage sector in 2006 and 2007 was the delinquencies and defaults on mortgage loans. Why? Well, essentially speaking, back in the mid-2000s, too many homes were produced, and the banks who had financed the builders to make those homes basically ran out of people with good credit to stuff in those homes. So what did they do? Well, they created subprime mortgages, and the subprime mortgages were, adjustable rate loans. So at that time, the Federal Reserve in the early 2000s lowered short-term interest rates to 1% on the Fed funds level, which allowed these adjustable rate mortgages to sell at discount price, these ultra-low adjustable rate interest rates. And they issued those loans and advertised them out to those with low credit, and it got absurdly ridiculous. It got to the point where they were basically handing out mortgages to anybody. You didn't need a job. You didn't need to post any kind of collateral. They just hand them out because it was just a frenzy. Housing prices were going up, and the banks were wanting to profit. And, of course, when you issue out to people who can't pay back, they don't pay back, and so the delinquencies and the defaults started to pick up. And it just snowballed from there. And since the whole thing was backed by the U.S. government, it was looked at as being safe and secure, and that helped fuel that kind of low interest rate frenzy to pile as many people into homes as possible. Since then, though, since the wake of the housing bust, the environment has changed completely in the housing mortgage industry. One thing is that during the height of the 2000s, subprime adjustable rate loans comprised as much as 40% of mortgages during the mid-2000s. Right now, subprime is no more than 10% of all existing mortgages. Rest of the mortgages are on normal fixed-rate loans. So that, with all that being said, it's a much more stable environment. What popped the bubble in 2005 was that the Federal Reserve raised interest rates sharply from the Fed funds level of 1% to 5% in as little as 2 years. And by raising those interest rates in such a short period of time, it sharply increased the rates on those adjustable rate mortgages, which then led to a rising cascading series of delinquencies and defaults. Now, the Federal Reserve is hell-bent on keeping interest rates as low and as long as possible. And eventually I was concerned, and I created another video detailing a model where I was concerned that rising inflation rate would push up interest rates to sort of force default rates up. But right now, interest rates are staying relatively low, and with inflation temporarily abating off, feeding into that Fed narrative and probably reinforcing the Fed to keep interest rates low, I don't see that that's going to be a problem, that we're going to see rising delinquencies and defaults on loans. Well, what about the eviction crisis there? Wouldn't that increase the delinquencies and defaults? Not really, because the eviction rates is for renters. So one of the things it could do is that, yes, with renters being thrown out, it could lower rental unit prices relatively speaking, and yes, it could increase the amount of housing units available to rent, which could put some downward pressure on this sharp increase in price. But with the record amounts of active listings available, that in itself I don't think is going to be enough to push down the prices. Even if prices on the homes do get pushed down, that does not mean it will lead to a massive wave of bankruptcies on mortgage loans. The only way that could happen, and I doubt that banks would be dumb enough to do this, was that if the banks realize that the asset values of those mortgages are lower than the liabilities that they hold for those mortgages. So in other words, they measure those assets as part of the housing price, and if the housing price drops, well, the amount owed on those mortgages by the homeowners doesn't change, but the asset value does. So then homeowners' equity actually depreciates, and it could lead to a point where homeowners are technically underwater on those mortgages. When you're underwater, you're in a very dangerous situation. You basically owe back more than what the house is worth. Now, typically speaking, banks won't really, would be an unusual situation, but typically speaking, banks would not cut their losses on this as long as the homeowner is able to sustain their payments and make payments on their mortgages. It's when we start seeing a rise in delinquency rates on loans that we see here, just like we did in 2006, that it would prompt banks to do what is called call in the loan. What they do by calling in the loan, they basically escalate the mortgage to force the homeowner into foreclosure. How do they do this? They basically say, hey, you're late on these payments. If you don't start making payments, we're just going to say you owe us back all the money. You're going to have to pay back all the money. So if you borrowed $200,000 and you owe still $190,000, if you go delinquent for a certain amount of time, banks will reach a point where they say, you got to pay us back all the $190,000. We don't trust you anymore. You're not a reliable, credit-worthy homeowner. And the reason why they would do this is to escalate the house into foreclosure so that they could resell the home. And by reselling the home, they could theoretically recoup some of their losses, or able to turn that around into a performing loan to somebody who would become a would-be homeowner and would have good credit and would maintain those payments. The problem that happened in 2005 and 2006 is that everybody that defaulted and had delinquency rates on loans, the rest of the homeowners were already saturated. That good credit market was already saturated. So what's going on right now? Well, the credit market is probably already saturated with homes, but we're not seeing a turnout of record inventories of homes to force down those prices. So I don't think that's what's going to be forcing down those prices. Another thing to consider here is to take a look at what's going on with income. So one of the things that Michael Burry noted back in 2003, and this was something that was captured in the movie The Big Short, there he argued with a fellow investor that he called Lawrence, and I don't know if those are the real names or not. I know that Michael Burry is the real name of the character in the movie, and it's based off of a true story, but he argues with one of his chief investor backers, and his name is Lawrence. And so basically they're arguing over whether there's a housing bubble or not. Michael Burry makes this wise notion. He notes that during the current times, this was back in 04, 05, that incomes were basically flat, but homeowners' prices were going up. And so therefore, it could be looked at that the home was actually a debt and not an asset, because if the price is appreciating without an appreciable or a complementary increase in income, it was an unsustainable increase in price, and it was being fueled by debt, and it was actually going to turn into bad debts. It would reach a point where there's too much debt in the system and not enough income to pay back those debts, particularly if interest rates are raised. Now, back in the 2000s, Alan Greenspan, who was then chairman of the Federal Reserve, was lured into a false sense of belief that the economy had recovered, and that's when he tried to normalize interest rates, which, of course, pricked the bubble and crashed. I don't think that the Fed is going to be so reckless this time. Instead, what I imagine is that the Fed is going to be much, much more cautious about raising interest rates and tapering asset purchases, which, of course, will fuel that housing bubble further. Now, is housing in a bubble? Well, compared to the 2000s, let's take a look at personal income. So personal income on an annualized basis, and I index this back to the year 2000 to show you the change compared to the home price index, was about 70 to 75% of home prices on an index level, meaning that home prices were about 30 to almost 40% above what incomes would justify those home prices. Are we seeing that issue now? The short answer to this is shockingly no. Well, why? I mean, home prices are going up. Yes, that's true. But ever since the bubble was pricked of housing back in the 2000s, housing prices went through a huge crash. And throughout most of the 2010s, and this is one of the reasons why, despite home prices were increasing again, personal incomes on a nominal level are much higher than they are. And with the onset of federal stimulus to try to cover the losses that were sustained during COVID, personal income has pretty much kept pace with housing. Now, just recently, housing prices have started to go up, okay? So housing prices are increasing right now, and they are increasing above personal income. They're about 10% higher, but that's nowhere near the 30 to 40% levels that we were seeing in the mid-2000s. One other thing to look at is to look at the total financial obligations that a household has to face when they're met with their disposable personal income. So their disposable personal income is their income minus their necessary expenses that they have left to spend, and usually to pay down on debts, okay? So your housing financial obligations are your mortgages, any other types of loan debts that you've got, and any other types of mandatory payments that you've got that you have to make right then and there. It is as a percentage of that, your financial obligations have typically fluctuated between 15% and about 18%, give or take. Notice that financial obligations started to pick up a little bit and started to push above 18% at the peak of the housing crisis when housing was really starting to escalate downward. And that would tell you that interest expenses were increasing, which forced that up, and it just sort of popped that bubble, combined with the fact that you had a lack of a growth in incomes. But what's going on now? Well, ever since the Fed has lowered interest rates down to zero and kept them perpetually in zero, combined with lower housing prices, household financial obligations have been lower. People have been taking on relatively less debt than they've had in the past decades. They've had a little bit of a higher savings rate. And look what's gone on in the midst of the COVID crisis. People and households have been paying down their debts. They've been using that stimulus, but they've been stocking it away as savings, and they're not really taking on new debt and forcing up those financial obligations right now. They're at record lows. So your financial obligations right now are at about 13%, give or take. And part of that, again, is due to the fact that the government has juiced the economy with fresh fiscal stimulus. But essentially, it has worked to stabilize the mortgage market for now. We're not going to see a rise in default rates, I don't think, on that front. The only thing that's a risk now is that higher housing prices could prompt a wave of home builders to borrow money at record low interest rates to start to increase this inventory. And when that inventory increases, it then prompts and stops that housing price increase and may actually turn it downward and have housing prices regulate. But if the builders were anticipating on making a profit based off of the expectation that home prices were going to continue to increase or stay at those high levels, and they miss and make a calculable error, which is probably what happened in 2006 and 2007 here when home prices peaked, then it could prompt a wave in the home building industry. And that could prompt losses on the banks. But it would only be in that sector. And to be honest with you, I don't have the economic data to see if that would feed back into a total collapse of the economy or whether it would cause a slowdown. The reason why economists missed the mark here on the housing bubble was that even though those who were aware that housing prices were increasing unsustainably, no one ever anticipated that the subprime mortgage rates would cause a massive wave of bankruptcies, which would then cause the housing prices to crash to such absurdly low levels as they did. It was that, combined with the losses that the home builders had in the investment industries for building homes and building residential properties, was what made the 2008 crash so hard, because the banks got hit on both ends. They lent out to the home builders and took on losses. Then they lent out to mortgage owners and they took on losses. When they tried to recapture those losses by making claims on insurance companies who were backing those mortgages, like AIG and such, those insurance companies crumbled because they got hit with so many mortgage defaults and claims of payments or reimbursements all at once, which is what totally collapsed the financial system here. So one last thing to note is to take a look at the private residential fixed investment. Okay, so one of the things I want you to look at is that look around 2000. Notice how that mortgage debt started to increase unsustainably beyond residential fixed investment. Okay, so the investors who were investing in producing the supply of houses, the demand was outstripping the supply, and while the demand was outstripping the supply, that helped fuel the home price increase, making it profitable. But when those mortgages started to drop based off of an increase in defaults, all of a sudden the housing prices started crumbling down, and with it, so did residential fixed investment. Why did the fixed investment drop? Well, it was because they were anticipating that they were going to make profits on ever increasing prices in the home prices. But when home prices started to level off, they started to drop off on investing in building more and more houses. To them, that signaled that there was enough houses out in the market, and they were basically cutting their losses. So what's going on right now? Well, residential investment is outstripping mortgage debt. So supply is outstripping demand right now. Does that mean that we'll have a downward pressure on prices? Likely not. And the reason why is because we don't have other than this small jump right here in Q1 and Q2, and that's probably due to rising housing prices. We are not seeing a point where housing demand is going to create that bubble of forcing up housing prices to oblivion, which causes the mad frenzy. Instead, what we're having is an increase in housing investment driven by higher prices because of lower availability of homes coming out to market. So this is actually the market working as it's supposed to fill that need to supply to supply our economy with more houses, which will taper down those housing prices. But then what we'll see is just a turn downward, just like we saw in the mid-2000s of home price fixed investment. Without the rise in default rates, I doubt it will cause a crash in the housing market on the levels that we've seen in the 2000s. But that's my take on it, guys. I'd like to know and see what your take is on it. What do you think that you've seen? Is there anything that I've missed in my analysis on this? I know it's been a while since I've produced the last video, but I have been watching and taking note on what others have been reporting on, and I'm just giving you my honest take on it. I'm not always doom and gloom on everything, and I'm not always a perma bull or a perma bear. What I do is try to give you the most accurate insight that I can to tell you what the most likely outcome is going to be in the future. So guys, I thank you for watching this video. Comment on the video. Tell me what you feel and what you think about all this that's going on, if it's concerning to you or not. I do think it will be of a concern in several years from now, particularly if interest rates are forced up from higher inflation, but right now that's just not the case. Guys, make sure you click the like on the video, subscribe to my channel if you haven't already, click that notification bell when you want to, so that way whenever I do upload another video, I will, most certainly I will be uploading another video sometime this weekend, probably going to be talking about the recent surge in gold and silver prices. So until then, I'll talk to you next time.